The real estate industry on Friday welcomed the much-awaited benchmark rate cut of 25 basis points by the Reserve Bank of India. This marks the first repo rate cut in nearly 5 years and will likely lead to a fall in interest rates and equated monthly installments on home loans and personal loans. In an unanimous decision, the RBI MPC lowered the repo rate to stimulate economic activity by making borrowing cheaper, thereby encouraging spending and investment.
Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation after moving above the upper tolerance band in October has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect.
According to Boman Irani, President Credit National, the decision supplements recent announcements in the union budget aimed at boosting spending and spur economic growth. This supportive monetary policy was imperative, especially after the recent 50 basis point reduction in the cash reserve ratio, which has already injected significant liquidity into the banking system, he mentioned. While the current cut may have a limited direct impact, we anticipate that a further rate cut in the next MPC meeting will provide stronger impetus to overall demand, accelerating housing sales, particularly in the mid-income and affordable segments, said Irani. Dr. Niranjan Hiranandani, Chairman, National Real Estate Development Council, said, after a period of steadiness in the repo rate, this long-awaited and strategic move comes at a crucial time. He noted that, as inflation is now under control, the fiscal deficit remains moderate and economic growth is expected to accelerate steadily. The reduction in the repo rate signals a renewed sense of resilience. Additionally, it assures us that, despite external geopolitical uncertainties, our domestic economic climate keeps markets efficient and demand robust. Combined with the tax benefits announced in the financial year 26 budget for the middle class, this policy change will boost sales velocity, said Hiranandani. This rate cut, the first one since May 2020, is likely to boost consumption and investment. Increased liquidity in the banking system will help address market constraints, benefiting sectors like infrastructure and housing largely.